John has $1 million sitting in his investment account. And right now, he's staring at a very tempting option, a $1 million house. The numbers line up perfectly. If he wants to, he could transfer the money, pay for the house in full, and walk away with zero mortgage, zero interest payments, and complete ownership. For a long time, that decision would have seemed obvious. If you have the money and you want the house, you buy it. Simple. But John pauses because the moment he makes that purchase, something else happens at the exact same time. His account balance drops to zero. No investments left, no flexibility, no cushion. And that realization changes the entire equation, because having $1 million sitting in an account does more than just represent purchasing power. It represents options. Unexpected expenses don't create panic. Investment opportunities don't feel rushed. Life simply feels more stable when there's capital sitting behind your decisions. But when that account drops to zero, everything changes. Even small financial surprises suddenly matter more. The money doesn't just disappear. The security it provided disappears with it. And that's the part most people never stop to think about. They focus on buying the house, not on what life feels like after the money is gone. So John asks himself a different question. Instead of asking, can I afford this house? He asks something far more interesting. How fast can I double this $1 million? Because if he can turn $1 million into $2 million, something remarkable happens. He could buy the house in cash and still keep $1 million invested in his account. Same house, same purchase, completely different financial outcome. So now the problem becomes incredibly simple. Everything depends on one thing. How fast can $1 million realistically become $2 million? That's the question we're breaking down in this video. We'll look at several ETFs that grow money at very different speeds. We'll start with the most familiar and conservative option, the type many investors already use as their baseline. Then we'll gradually move toward faster and more aggressive strategies. For each ETF, we'll examine three things: what the fund actually owns, how it historically grows, and what happens to John's $1 million portfolio year by year until that second million finally appears. Some ETFs will take around 6 years to reach the goal. Others shorten the timeline dramatically. And by the end of this video, you'll see one ETF capable of pushing that timeline down to as little as 2 years. Same starting money, same goal. The only thing that changes is the strategy used to grow it. To understand how the timeline begins, John starts with the most familiar option of all. The ETF many investors treat as the foundation of the entire market. That starting point is the Vanguard S&P 500 ETF, ticker VOO. For many investors, this fund is the baseline. If you ask someone what it means to invest in the market, this is usually what they're talking about. VOO simply tracks the 500 largest publicly traded companies in the United States. Nothing fancy, no active manager making bets, no complicated strategy trying to outsmart the market. The fund simply owns the dominant businesses that already power the U.S. economy. Companies like Apple, Microsoft, NVIDIA, Amazon, and hundreds of others that shape everything from technology to healthcare to finance. And because the fund is weighted by market value, the companies performing the best naturally become a larger part of the portfolio over time. The winners gradually rise to the top. That's why VOO has become one of the most widely held ETFs in the world. It's simple, it's diversified, and it's incredibly cheap to own. The expense ratio sits around 0.03%, meaning it costs just $3 per year for every $10,000 invested. But the most important number is the growth rate. Over the past 10 years, the S&P 500 has delivered roughly 269% total growth. When that performance is averaged out across the decade, it comes to about 12.61% per year. That number becomes the foundation for projecting what might happen next. So John places his $1 million into VOO and watches how the timeline unfolds. After the first year, the portfolio is projected to reach approximately $1,137,200. Nothing dramatic yet, just steady compounding beginning to work. By the end of year 2, the account climbs to around $1,292,395. Now the growth becomes easier to see. Moving into year 3, the balance increases again to roughly $1,467,888. By year 4, the portfolio approaches $1,666,277. At this stage, the compounding effect becomes difficult to ignore. Each year is now adding larger and larger dollar amounts to the account. In year 5, projections place the portfolio near $1,890,488. And then something important finally happens. By year 6, the portfolio crosses the milestone John has been waiting for. The projected value reaches approximately $2,143,818. That's the moment the second million appears. At that point, John could withdraw $1 million, buy the house outright, and still have his original $1 million invested. No mortgage, no interest payments, and the investment account remains intact. But there's one trade-off. It took 6 years to get there. VOO offers reliability, diversification, and stability. But speed isn't its strength. And once John sees how long it takes, even when owning the biggest companies in the market, another question becomes impossible to ignore. If this is the timeline when he owns the leaders of the entire market, what happens when growth itself becomes the priority? That question leads him directly to the next ETF on his list. The next ETF John examines is the Vanguard Growth ETF, ticker VUG. At first glance, it looks very similar to the S&P 500 fund he just analyzed. It still owns hundreds of American companies. It's still diversified, and many of the biggest names overlap with the previous portfolio. But there's one important difference. VUG filters the market. Instead of owning everything, it focuses on companies expected to grow faster than average. These are businesses that reinvest aggressively into expansion, companies that push revenue growth harder than the broader market, firms willing to sacrifice dividends today in order to build larger profits tomorrow. Because of that filtering process, the composition of VUG looks noticeably different. Technology companies take a much larger role. Communication platforms and high-growth businesses move toward the top of the portfolio. Meanwhile, slower-growing sectors receive far less weight. The idea is simple. Instead of owning the entire economy, the fund tilts toward the companies pushing the fastest expansion. That shift changes the growth rate. Looking back over the last 10 years, VUG has produced roughly 402% total growth. Spread across the decade, that works out to an average annual return of about 15.31% per year. That difference may not sound huge at first, but over time, small increases in growth rates dramatically compress timelines. So John runs the projections again. He places his $1 million into VUG and watches how the numbers unfold. After year 1, the portfolio is projected to reach approximately $1,157,300. Already slightly ahead of where VOO stood after its first year. By year 2, continued growth pushes the account to around $1,338,782. Now the gap between the two strategies begins widening. By year 3, the projected balance climbs to about $1,548,150. That's more than halfway to the second million. Moving into year 4, the portfolio reaches approximately $1,789,673. The compounding engine is now working at full speed. And then the moment arrived sooner than before. By the end of year 5, the projected balance crosses the line at around $2,068,274. The second million appears one full year earlier than it did with the S&P 500. And that difference comes from one simple adjustment: prioritizing growth over balance. Bug proves that leaning toward faster growing companies can move the timeline forward without dramatically increasing complexity. But John isn't done asking questions, because now he's wondering something else. If leaning toward growth can shave an entire year off the timeline, what happens when the strategy stops being broad and starts becoming focused? That curiosity pushes him toward the next ETF. The next step takes John into a much narrower part of the market, the Vanguard Information Technology ETF, ticker VGT. Up until this point, every ETF John has looked at still tried to represent a large portion of the economy. VO own the biggest companies across every sector. VUG filtered for faster growing businesses, but still spread across hundreds of firms. VGT does something very different. It concentrates almost entirely on one sector, technology. Inside the fund are companies building the digital infrastructure behind modern life: software platforms, semiconductor designers, cloud computing providers, hardware manufacturers. These are the businesses responsible for the tools people use to work, communicate, and build new products. Technology companies often scale faster than traditional industries. Once software is developed, it can be distributed globally with relatively small additional costs. That scalability is one of the reasons tech companies can grow earnings so aggressively. And VGT captures that part of the market directly. The fund still holds a few hundred companies, but the sector focus creates much stronger momentum when technology leads the market. Of course, that concentration comes with a trade-off. When the tech sector struggles, the swings inside this fund can feel much larger than broader market ETFs. But historically, technology has delivered exceptional growth. Looking at the last 10 years, VGT has produced roughly 676% total growth spread across the decade that averages out to about 22.03% per year. That kind of growth dramatically changes the timeline. So John runs the numbers again. He places his $1 million into VGT and projects what happens next. After year 1, the account is expected to reach approximately $1,224,400, already well ahead of the previous strategies. By the end of year 2, the portfolio climbs to roughly $1,498,138. Now the difference becomes obvious. Moving into year 3, the account reaches about $1,832,820. At this point, the second million is already within reach. And then the breakthrough happens. By year 4, the projected value rises to around $2,239,497. The portfolio crosses the $2 million mark, which means John can now withdraw $1 million, purchase the house outright, and still leave his original million invested. Just by focusing on technology, the timeline dropped from 6 years to 4. But that realization sparks another question in John's mind. If concentrating on the technology sector can move the timeline this much, what happens when he focuses on the specific part of technology that powers everything else? That's where the next ETF enters the picture. Now, John narrows the focus even further. Instead of owning the entire technology sector, he looks at the industry powering all of it, semiconductors. That brings him to the iShares Semiconductor ETF, ticker SOXX. If technology is the engine of modern growth, semiconductors are the fuel. Every smartphone, every data center, every artificial intelligence model, every cloud platform, all of them depend on advanced chips. Without semiconductors, modern computing simply doesn't exist. And because of that, Companies producing these chips often experience explosive demand cycles. When global computing power expands, chip makers see revenue surge. But the industry is also known for sharp cycles. Periods of massive growth can be followed by sudden slowdowns when supply catches up with demand. That makes this ETF far more concentrated than anything John has looked at so far. SOX holds a much smaller group of companies, firms designing processors, manufacturers producing advanced chipsets, businesses building the hardware that powers artificial intelligence and global computing. Dividends play almost no role here. Returns are driven almost entirely by price growth. Looking at the last 10 years, the numbers are striking. SOXX has delivered roughly 280% total growth, spread across the decade that averages about 28.69% per year. That rate of expansion dramatically compresses the timeline again. So John runs the projections. He places his $1 million into SOX and watches the numbers unfold. After year one, the portfolio is projected to reach approximately $1,291,888, already moving faster than every previous ETF. By year two, the compounding accelerates the balance to around $1,668,165. Now the finish line is clearly visible. Then the shift becomes undeniable. By year three, the projected portfolio reaches approximately $2,153,124. The second million appears in just 3 years. That means John could withdraw $1 million, buy the house in cash, and still leave his original capital invested. 3 years instead of 6. But this discovery raises one final question. If concentration alone can compress the timeline this much, what happens when leverage is added on top of growth? That's the final step John decides to explore. And this is where John reaches the final step of his search. The ETF that removes the last layer of restraint, ProShares Ultra Pro QQQ, ticker TQQQ. Up until now, every ETF John examined followed the same basic rule. They simply owned companies and let those companies grow over time. TQQQ works differently. Instead of just tracking the NASDAQ 100, it uses leverage to magnify its movements. The goal is simple. For every 1% move in the NASDAQ 100, TQQQ attempts to move about 3% in the same direction on a daily basis. That amplification creates something very different from traditional ETFs. When markets trend upward, gains can accumulate extremely quickly. But the trade-off is just as clear. Volatility becomes a defining feature. Large gains and large drawdowns can both appear much faster. Looking back over the last 10 years, the numbers illustrate just how dramatic that difference can be. TQQQ has produced roughly 360% total growth spread across the decade that averages around 41.13% per year. That pace completely changes the timeline John has been working with. So he runs the projections one final time. He places his $1 million into TQQQ. After year one, the portfolio is projected to reach approximately $1,417,600. The account has already gained over $400,000 in just 12 months. But the real shift happens soon after. Before the second year is even complete, the projections show the portfolio crossing the $2 million mark at roughly $2,005,916. The second million appears in under 2 years. At that point, John can withdraw $1 million, buy the house in cash, and still leave his original million invested. When you line the timelines up side by side, the pattern becomes clear. BO takes about 6 years. VUG shortens the wait to around 5 years. VGT compresses it further to about 4 years. SOX brings the timeline down to roughly 3 years. And TQQQ pushes it to the extreme, reaching the goal in less than 2 years. Same starting money, same $1 million target. The only thing that changes is the strategy. And those decisions determine whether the timeline takes years or decades.
If you want to see how I would personally build a portfolio from scratch in 2026 with actual allocations and the reasoning behind every decision, click the video on the screen right now.